Today we are going to go through question 2 of specimen paper of AFM. I have covered question 1. Whoever have not seen my video, the first part of this, the first part and the second part where I went through question 1 of specimen paper of AFM, can click the I button on your right side and you will get to the first question. So now let's proceed. Okay. So question 2, which comes in the section B, question 2 and 3. There are two questions which comes in the section B in AFM. And question 2 we are going to attempt now, and it's worth 25 marks. So before reading the case study, I always recommend read your requirements. So let's go to the requirements. So these two are the requirements. A, calculate the adjusted present value for the project. It is highlighted in yellow because I have went through this question. So I have highlighted all the important keywords in yellow already. So the time is saved while I'm explaining. Calculate the adjusted present value for the project. Require correcting any errors made in the net present value estimate above. So a net present value estimate has been given above, which we will go, which needs to be corrected before you make your adjusted present value. So please make sure that adjusted present value is a topic which regularly appears in your exam. So you have to be very thorough with it, not just the net present value, because what happens is most of us, we just focus on net present value, but we don't focus much on APV, that is adjusted present value. So make sure that you don't avoid this topic altogether and you don't ignore and go through, attempt all the questions where you have to calculate adjusted present value, right? And conclude whether the project should be accepted or not. Show all the relevant calculations. So first part is for your calculations. Second part, let's come to B. Comment on the corrections made to the original net present value and explain the adjusted present value approach taken in part A, including any assumptions made. So that is like a theory part. B is like a theory part. You are commenting on your part A. In B, if you see, there are three requirements you have to, right? You have to write about. First, you have to comment on the corrections. Second, you have to explain which approach you have taken for your adjusted present value. And third, assumptions. You have to include any assumptions made, which is worth 10 marks, then 15 marks, right? So first we'll do A, because always calculations you have to do before you attempt your theory part. See, most of the theory part, right, it's always linked to your calculation part. So now let's read the case in detail. Okay. You have recently commenced working for Burang company and are reviewing a 4-year project which the company is considering for investment. So it's a 4-year project, okay? And the project is in a business activity which is very different from Burang company's current line of business. Let me go here. So the following net present value estimate has been made for the project. All figures are in $million. Okay. So you have been given the sales revenue, the cost, the interest, the profit, the tax, the initial investment, which is 38 million. Cash flows and discount factor has been at 7%, and then the present value, right? And let's see. I have highlighted in yellow already. They are saying that the net present value, right? Net present value is negative 1.65 million. What does it mean? Therefore, the recommendation that project should not be accepted. As simple as that, right? Now let's go to the notes. In calculating the net present value of the project, the following notes were made. Now, let's go through this. The first one, since the real cost of capital is used to discount cash flows, I hope that by now you know what is a real cost of capital and what is a nominal cost of capital, right? is used to discount cash flows. Neither the sales revenue nor the direct project costs have been inflated. So the real cost of capital means you are not taking inflation into account. Uninflated amounts you have put. That is, then you have to use real cost of capital, like in this. But if you have inflated an amount, then you have to use the nominal cost of capital. So here they have not inflated, right? It is estimated that the inflation rate applicable to sales is 8% per year and direct project cost is 4% per year. So you can see that the inflation rate is different for sales and different for cost. Okay. Next, the project will require an initial investment of 38 million. Exactly, right? It's given here 38 million. But out of that initial investment, okay, of this, 16 million relates to plant and machinery, which is expected to be sold for 4 million when the project ceases. That means the end of the year. Project ceases means end of the year, the fourth year in this case, because it is a 4 years project, right? But what are they saying again? After taking any taxation and inflation impact into account, right? Now let's go to the third one. Third one is about tax allowable depreciation, and this is the area where you have to be very concerned about, because this area most of the people make mistakes in this area, right? The calculation of it. So tax allowable depreciation, you will be getting a, wherever net present value is there, wherever APV is there, you will get a question. I haven't seen one question in the past paper till now where tax allowable depreciation is not being given. So you have to know, right? You have to know there is no option whether I should learn tax allowable depreciation or, there is no options like that. You have to know. You must know tax allowable depreciation is available on the plant and machinery at 15% in the first year. That means tax allowable depreciation on plant and machinery. What is the amount of plant and machinery? Just check a second. Just check on your second node. 16 million relates to plant and machinery. So out of that 50%, that means 8 million will be for the first year, the tax allowable depreciation. Now let's see what are for the other years, 2, 3 and 4, followed by 25% per year thereafter on a reducing balance basis. There are two bases which you can calculate your tax allowable depreciation. One is known as straight line basis and the other one is reducing balance basis. You have to know both. But in the exam, they will make it very clear which basis to use. Like in this case, it is reducing balance basis. So don't go and use straight line basis, right? A balancing adjustment is available in the year the plant and machinery is sold. A balancing adjustment, okay? So keep this in mind when you do the tax allowable depreciation, especially for the last year. There will be a balancing adjustment. Borrowing company pays 20% tax on its annual taxable profits. 20% tax. No tax allowable depreciation is available on the remaining investment assets. And they will have a nil value at the end of the project. Right? Now, borrowing company uses either a nominal cost of capital 11% or a real cost of capital 7%. You have seen here, let's check here. They have used the real cost of capital 7%. Can you see here? Right? They have used 7%, but it is okay, nominal cost of capital or real cost of capital to discount all projects, given that the rate of inflation has been stable at 4% for a number of years. Why are they giving this nominal cost, real cost and inflation? Can you come up with some equation? Yes, the Fisher's equation. Through Fisher's equation, you can calculate, you can check whether the nominal cost of capital is correct or not, because real cost of capital, if you know inflation and real cost of capital, you can calculate nominal cost of capital, right? You will be getting 11% only. That is given for you to decide which rate to use for discounting the project, real cost or nominal cost. But just now don't take a decision. We'll read further and then we'll come. Okay. Interest. The fifth point, interest is based on borrowing company's annual borrowing rate of 150 basis point over the 10-year government nil rate. Right? At the beginning of each year, borrowing company will need to provide working capital of 20% of the anticipated sales revenue for the year. 20% of the sales, that means, right? Any remaining working capital will need to be released at the end of the year. Working capital part also you need to know. This working capital part also you will get in the question. Often you will get, right? So you cannot miss this out. You have to know how to calculate the workings. And finally, the last one, working capital and depreciation have not been taken into account in the net present value calculation above. Since depreciation is not a cash flow, we all know that, and all the working capital is returned at the end of the project. Now there are further financial information. Let's read it. It is anticipated that the project will be financed entirely by debt, 60% of which will be obtained from a okay, now you tell me, by just reading the first line itself, you can understand why that further information is given. This is before reading this further financial information. All the information which we have read till now, it is just for correcting your net present value. That's it. Now the things which we are going to read, further financial information, these are the information you need for your adjusted present value, right? The word debt, finance entirely by debt itself, should be able to tell you that it is related to your adjusted present value. You also need to know which information to use where. That is a very important skill in your AFM. Which numbers to use for which one, right? You will be given so many numbers and you will be confused which one to use where. So you have to know which one you need to correct your net present value. You need to know which one you need for calculation of adjusted present value. So you have to be very sure of that, right? So it is anticipated that the project will be financed entirely by debt. Because adjusted present value, what is it? It is nothing, but it is also taking into account the impact of finance, right? The impact of financing a project. That is adjusted present value. Because net present value you calculate based, okay, assuming that it is entirely equity based. Now you're also taking the debt finance into account, the impact of debt finance. That is known as adjusted present value. That's why this information is important there. So 60% of which will be obtained from a subsidized loan scheme run by the government, which lend money at a rate of 100 basis points below the 10-year government debt. Okay, of course it will be below the 10-year government yield rate of 2.5%, because remember it's a subsidized loan, right? Subsidized loan will be anyway, the borrowing rate will be lower than the normal borrowing rate or the 10-year government rate. So issue cost relating to raising the finance are 2% of the gross finance required. The remaining 40% will be funded from borrowing company's normal borrowing cost. It can be assumed that the debt capacity available to borrowing company is equal to the actual amount of debt finance raised for the project. So that means debt capacity has been utilized completely. And borrowing company has identified a company, Linto company, which operates in the same line of business as that of the project it is considering. Now, when you read such lines, some idea you have to get. Some idea should pop out in your mind. What is it? You always have to question whenever you're reading an information. Don't just blindly keep reading. Okay? Ask this question to yourself, why this information is given to me there? Because this is the only way you are going to learn and understand things very clearly. Why this piece of information is there? Then only you know how to use it. Right? Over the years, I have developed the skill that whenever a piece of information, don't just blindly take some numbers. I just have to take it and use it and know. Ask this question, why is it important? So now why Linto company's information is given? That it is in the same line of business. Okay. We usually use it for what? Exactly to calculate beta. Right? To calculate the equity beta. To calculate the asset beta. By using that asset beta, ungearing, re-gearing, exactly for that purpose. So that we can find the cost of capital. Why we want to find the cost of capital? Because we have to discount the project, right? We need a cost of capital, appropriate cost of capital. So that's why this information is given. Let's read it further, right? Later companies financed by 40 million shares trading at 3.2. That means equity is there, and 34 million debt trading at 94 per 100. Debt is also there. Linear company's equity beta is estimated at 1.5. That means we have to find the asset beta of this Linto company. And then using CAPM, find the cost of equity, right? Now, the current yield on the government treasury bill is 2%. What is this current yield on government treasury bill is 2%? That is a risk-free rate, because it's a government treasury bill is a risk-free rate, right? So it is 2%. Indirectly, okay, they are not saying risk-free rate. Indirectly, that's what they mean. They're giving you a government treasury bill, right? Because we are so used to this risk-free rate, that if it's not there, we panic. Where is the risk-free rate? This is the risk-free rate. Okay, and it is estimated that the market risk premium is 8%. So you can use your CAPM model to find the cost of equity. That's why they have given this information. Linto company pays tax at an annual rate of 20%, right? Now, both Burang company and Linto company pays tax in the same year as when the profits are earned. This makes your problem a little easier, because you don't have to worry about in the next year, or half this year, half next year. It becomes very complicated. So now it's very easy because it's in the same year. So now you are again, let me read the requirements. Let me see whatever I have understood is correct or not. Okay, calculate adjusted present value, correct the errors made in the net present value, conclude whether the project will be accepted or not. Second is you have to comment on the corrections made, explain the APB approach which we used, and any assumptions made. So first we'll go through A. Right, before I show you the answer, let's work on this, right? This is because the calculation part and all, how they have got, they didn't show you, they just show you the final calculations, right? So how are you going to start this question? That's my first question to you, is how are you going to start this question? Okay, this is first you have to do calculation question. Okay, so many requirements are there. First, are you going to calculate adjusted present value, because that's what they asked, that calculate adjusted present value, or first you have to correct the net present value? Of course, first you have to correct the net present value, then only you can calculate the adjusted present value, because you need the base case net present value to calculate the adjusted present value, right? Without that you cannot calculate adjusted present value. So first what we have to do is we have to correct this table, right? Whenever you have to correct something, right, some figures or something, whenever this situation comes to you that you have to correct some figures, this is how you have to proceed. You have to start with the way it is given in the question. In the question you can see that this is in a table format, right? Exactly what you have to do is you also have to write in the table format. That means first you have to start with sales, then the cost, and then rest all, right? So first thing is, let's go line by line, start with the order, start in order. So first thing, you also are going to create a table like this, and then you are going to write all figures are in dollar million. This thing you have to write it, right? Because you are not going to deal in millions, so, and you don't want to mess yourself by dealing with so many zeros. So you also have to write 0, 1, 2, 3, 4, and then we start with sales. This is uninflated sales. What you have to do, you have to inflate the sales by how many percent? By 8%. So let's do that. First year when you have to inflate the sales, right? This will be the working. I will show above. Okay, so for the first year it will be 23.03 multiplied by 1.08. to the power of 1 because it's for the first year. So you will be getting how much? And keep your answer into 2 decimal places. 24.87. You'll be getting 24.87. I'm not writing the answer down. Later I will show you the answer, but just the workings and all I'm writing here so that later you can refer to the workings. Let's come to the second year. Second year it is 36.6. This also you have to inflate again by 8%, but okay, because just see in the first year you cannot inflate again by 8% when you come to the second year, because the sales figure for the second year is different. The sales revenue for the second year is different. So on 36.6, okay, let me keep this line. 36 point, okay, on this value you are inflating into, I'm writing it down, 1.08 squared to the power of 2, because this is for the second year you are inflating. So 36.6 into 1.8 squared. Keep your answer with you. Later we'll check what is the answer. Third year we have 49.07 multiplied by 1.08 to the power 3, and finally we have 27.14 to the power 1.08 to the power 4. Right, keep your answer. Let's go to the direct project cost. Direct project cost has to be inflated by how many percent? 4%. I recommend that you keep the question paper in front of you when doing this with me, so that you don't have to keep going back to my video to check, right? What is the percentage, which inflation rate to take and all, right? So direct project cost is 4%. Same, I'm not writing this whole thing again. The same way we have done for sales, I'm going to inflate, but just the inflation rate is going to be 4%. That's it. First year it will be 13.82 multiplied by 1.04 to the power of 1. Likewise for the other years, just inflation rate will be 4 and keep changing the powers to the number of years, right? Then the third, interest. Okay, interest will not go to answer. You're not taking interest when you calculate net present value. Why is that? Can anyone tell me why we don't take interest when we calculate net present value? Right? Okay, so let me tell you why. Because that interest rate which you are using, right, you are using it when you are calculating the cost of capital, the discount rate. So that is taken in the discount rate. Anyway, when you discount the project, you are taking that interest there. That's why you are not taking here, right? Then we have to come to a profit here, taxable profit, right? So the taxable profit, first you have to get the profit, the sales minus your project cost, right? The inflated, the one which you have newly calculated, that sales minus your project cost, okay, that will be your profit. But now you also have to deduct your tax allowable depreciation before you can calculate tax. Now for tax allowable depreciation, you need to do some working, right? Let me take you to the answer now and show you, and you can see whether your sales revenue and your this thing is correct or not, right? So this is your, let me zoom it a little bit for you. Can I? No, I'm not able to zoom it more because this is the maximum. So you can check your sales. It has been inflated by 8% and 4%, and check whether all your figures are correct or not. And that word is known as incremental profit. After that, you are deducting tax, right? But before you deduct tax here, just see that it has working 1, right? So whenever you have to do a question like this, always keep 2 pages. In your first page, always your final answer has to be there on your first page, right, in the beginning. And your working has to be later, like it had to come later. So always keep some space for your final answer. I recommend 1 page or 2 page depending on the amount, right, the size your answer will take. For example, this calculation itself I think will take half a page, and then you have to write on it, so it will take around 1 page. So keep it and then go to the next page and do your workings. Don't do your workings where you are giving your main answers. Where you are providing your main answers, don't do your working there, because then it looks very messy. So many numbers to deal with. Everyone will get confused, right? Like this, for example, like this tax. In bracket, they told working 1. So whenever we want to find how they have calculated tax, what we'll do, I will go to the next page and find the working 1. So that's how your answer has to be like that. Present your answer this way. Now let's go to the working, right? So incremental profit they have taken from this itself, 10.5, 18.94 and all, and tax allowable depreciation. Okay, so before you calculate tax, you have to calculate your tax allowable depreciation. They haven't given the working here, but I will give you the working how they have calculated the tax allowable depreciation, because it's very important that you know how to calculate. Tax allowable depreciation is an area where most of the students get it wrong. So make sure that it does not happen with you. Okay. So for first year, it will be 8 because property, plant and equipment. Okay, let me write here. Cost of PPE was 16 million. And first year, year 1, I will write 50% of 16, which is 8. Therefore, the first year it is 8. Second year it's on reducing balance basis, 25% thereafter, right? So 8. So the cost is 16. 16 minus 8, right? You will be having 8 now. On this 8, you have to apply 25%. You will be getting how much? You will be getting 2. So exactly this 2 comes in the second year. And then 8 minus 2, 6. And for the third year, it will be 25% on 6, which will be how much? 1.5. Exactly. And when you go to the fourth year, right, it is 6 minus 1.5, which is 4.5, right? But make sure, but now hold on, it is not 25% of 4.5 for the final year. Why is that? Because you have already maximized, you have already used the 100%. Just check, this is 50%, 25 and 25, 100% is gone, right? And you are selling this for the 4 million, right? You are selling this for 4. That means you are at the end, it has to be sold for 4. Okay, you are selling this for 4. And in the requirements in the case study, you have seen that there was a balancing allowance will arise at the end in which the project ceases. So it ceases at the end of 4 years. So 4.5 minus 4 will be 0.5. This is your balancing allowance, 4.5. Right? Because you are selling at a less value. So it's a balancing allowance, 0.5. That's why in the fourth year, tax allowable depreciation is 0.5. And then you deduct your tax allowable depreciation from your profit and you get your taxable profit. On that you take 20% because tax is 20%, and you put here like the one where I have shown you the arrow, right? All the tax. Then second you have to deduct is your working capital. For that also you need a separate working. That's why it's working 2, right? Working 2. See how neat it is, the presented, how neat it is. Imagine if all the workings and all the numbers are presented in this main working, it will become so messy, right, for you to understand, and even for your eyes it does not look very attractive. So try to keep your answer very clean, very simple, very neat, right? Now let's go to the second working, working 2. Right, so working 1, I will put an arrow, tick mark, because it's over. All figures are in million. You always have to write this line. Now let's go to year 0, 1, 2, 3, 4. Working capital, they have told, was 20% of the anticipated sales, right? So 20% of the sales in the first year, right? You need working capital when? In year 0, you need to borrow. That's why it starts from 0, not 1, right? So 20% of sales, but sales comes in the 1 year, first year, right? So just go and check the first year sales and take 20% of that. Which sales? Not the one which is there in your question, the one which you have just calculated after inflating by 8%. This one. You have to use this sales on this and all the years 2, 3 and 4. So 24.87 into 20%, you will get 4.97. Exactly, that is your working capital here for year 0. Right? Even here, because that is 20% of sales revenue. Why you need to put in year 1 again? Because from year 1 onwards, whichever working capital you are working on, you are not taking the exact 20% of the sales revenue. You are just taking the balancing amount. Right? When you go to the first year, then you have to take 20% of the second year's sales revenue. Second year's sale is 42.69. Take 20% of that. It will be 8.54. Right? So 8.54. But out of this 8.54, already in the first year you have taken 4.97. So that means you're just increasing. It's like an increasing amount of working capital, right? 20% was 8.54 and already you have 4.97. So 8.54 minus 4.97 is 3.57. So this is the amount which you need in your working capital. And this is just, the first line is just for your working capital. 20% of sales revenue only you are taking. But the required is in your second line, the balancing amount, right? Now let's go to the third year. 20% of the third year sales will be 12.36, right? But how much you require? Just check. Okay, it's just the difference between these two, which is this one, required. But when you come to the third year, that means you are predicting for the fourth year sales, 20% of the fourth year, you must have seen that there's a decline in sales. That's why even the working capital reduced from 12.36 to 7.38. It reduced. So what happens if it reduced? This means even this will be negative. This amount will be negative. Why? Because 12.36 minus 4.98 will give you 7.38. It reduced, right? If something is reducing, your working capital will be then in negative. And finally, the fourth year will be this amount only, 7.38, because you are releasing the working capital at the end of the year, the fourth year. That's why it is just the same, right? And how do you know that your working capital required is correct or wrong? There's a way of checking it. Right? This is how you check whether your working capital required is correct or not. Just from your starting from 0 onwards, add 4.97 plus, okay, add this, deduct this because it's a negative, and deduct this. Finally, you should be getting here 0, because whatever you are requiring, right, you are releasing it at the end. So it makes sense that at the end it should be 0. If it is 0, that means your working capital required, your numbers are correct. You can be sure of that. So this is the way you have to check whether your working capital required is correct or not. At the end, you have to get 0. Now this working capital, the same working capital required, you will go and put here, right? 4.97 in negative in bracket because you require 3.57, 3.82, but this 2 will be okay, this and this will be in positive because you're releasing it, right? And then you come to initial investment, which is 38 million. You can check here, right? 38 million. And finally you are getting all your cash flows. Now now comes to the discount factor. It is 12%. Neither your real cost of capital or your nominal cost of capital is 12%. They have calculated this discount factor by using the other company which they have been given, right? So let's go to the working 3, right? It's just 2 lines. I will make it easy. You should know the formula to find the cost of the asset beta, right? All of you know the formula for asset beta. Let me write it. So asset beta is equity beta into equity plus debt. Okay, asset beta into equity divided by equity plus debt is your asset beta, equal to your asset beta. So this asset beta only you have to find. So your equity beta is 1.5 multiply by your equity, right? Asset equity beta has been given 1.5. Let me take you to the question. Here I have highlighted also 1.5, and then your asset value, how will you calculate? 40 million into 3.2. 40 into 3.2, you will get 128. And your debt, this is your equity E, and your debt, how will you get? 34 into 94, 94 per 100, 94 divided by 100, you will be getting 31.96. 128, you are getting 31.96. And yeah, so equity is 128 divided by 128 plus your debt 31.96, but this debt have to be after tax, and tax is 20%. That means after tax, that means multiply by 1 minus 0.2, that means 0.8. That's what they have shown here. So that means your asset beta is 1.25. Use this asset beta to find your equity, cost of equity, right? All equity finance discount that you are not taking back because you are only taking net present value as if all equity financed. Remember your base cost net present value, when you have to find, you only have to find net present value as if all equity financed. You are not taking debt. That's why you are not finding back. You are only finding cost of equity here. So that's why that 1.25 into 8%, because market risk premium is 8%, and 2% because risk free rate is 2%, the government yield. And then you are getting 12%, which is your cost of equity. Here you have used 12%. Just check. And then you are getting the present value, and when you calculate your add up your present values, the base case net present value is 8.62 million. It's a positive. It's a positive figure. Before you were getting negative 1.62. Now you are getting positive. Now, so base case net present value has been done. Now what is the next? Financing side effect. Now we have to find the financing side of it so that we can calculate the adjusted present value. Right? So financing side effect is this. Issue cost. Okay, let's start with the issue cost because that is the easiest to work with. Issue cost has been at 2%, right? So this is the way you have to work 2 over 98. If it was 3%, then it would be 3 over 97, right? 2 divided by 100 minus 2. That is the way you have to work the issue cost into 42,970,000. Where they got this amount from? This is the amount they require. This is the initial investment based on your net present value. Just check. This one. This only. Right? This 42.97. In year 0 you will get, that is your initial investment. So on that, right, this is the amount which you require, you need to borrow, right? So that you have to take that amount, and you are getting an issue cost, and it will be negative because it's a payment, right? Next, let's come to the tax shield. Okay, annual tax relief. You're getting a tax relief on what? On the subsidy loan you are taking, and also the borrowings. So for that, again, let's go to that information where they have told, yes, project is entirely debt finance. 60% comes from subsidized loan, and the 60% loan, what is the rate? 100 basis point below the 10-year government yield rate of 2.5%. That means 2.5 minus 100 basis point means 1%. So 2.5 minus 1, that means 1 point at 1.5%, right? So that's why let's go here and check, right? So this much amount they require, this much debt they have to take, right? The initial investment amount 42,970 million into 60%, because 60% is subsidized. 0.015, this is your 1.5%, and then 20%. Why is this 20%? Because tax is 20%, right? Addition, okay? Again, only 60% is debt finance out of this, but what about the other 40% that you have borrowed, right? So even that is also same 20%, except this rate. The rate is 4% now. How they have got this 4%? Let's go up and see how they have got that 4%. Right, so here the government, okay, the 10-year government debt yield rate is 2.5. Okay, just remember that, and let's go up and see. Interest is based on borrowing company's normal borrowing rate, okay, of 150 basis point over the 10-year government yield rate. So the 10-year government yield rate is 2.5%. This is 150, that means 1.5% more than 2.5. That means it will be 4%. This is how they have got the 4%. Right? So that's why they have applied 4% for the other 40% here. Just check 0.04. And they have added both this and they have got this. But this needs to be again. It is for the 4 years. Just check this word. Annual tax relief. Annually, for all the 4 years, they'll be getting this tax relief. So what do you need? Annuity factor. Right? The present value of the tax relief annuity. You are taking this amount and multiplying by 3.63. 3.63 is the annuity factor. How? N is the number of years, which is 4. When you check the annuity table, you will get it. Okay. By using N4, and the R is 4%. Then you will get 3.63. Right? For 4 years, 4%. So annuity factor is 3.63, and you are getting this. This is in positive, right? So tax relief. And the annual subsidy benefit. This one was tax relief, tax shield. Now just the subsidy benefit. You're not okay. So here, just check. This one, that is the amount borrowed, amount needed to finance this project. 60%, because subsidy is 60%. 0.025. Right? Because that is the government, the 10-year government debt yield they have used here. Right? The subsidy is given by the government, so they have used the government debt. Okay. Let's again go to the subsidy and check. Yes. So they have used the 10-year government debt yield of 2.5%. 2.5%, and then 80%. How 80%? Because 1 minus 20, 20%. Because tax is 20%, no? You have to take after tax. So 80% is the annual subsidy benefit, and then this also, it is annual subsidy benefit. Whenever the word annual comes, you have to use the annuity factor. It will be same only, right? The present value of the subsidy benefit. So what happens is, then you have to add this both, and then you deduct, and then you will be getting this answer. Total benefit of financing side effect. What do you have to do? You have to add this with what was your net present value? Base is 8.62 million. 8.62 million. So this will be around 1.78 million if you round up, right? 1.774, because this is in millions, no? We are done meaning, and that one was 8.62 million. 8.62 million. That will be your adjusted present value. Now let's see what they have written here. Financing the project, right, entirely by debt would add just another 1.78 million to the value of the project, or approximately an additionally 20% of all the equity finance project. What do you mean by 20%? 20% of 8.62 million, right? And adjusted present value of the project is just under 10.4 million. So the APV, just add both. You will be getting, right, 10.4, less than 10.4, because 1.7 you are taking a rounded figure. So just under 10.4 million, and therefore it should be accepted, because the requirement also asks you whether you will accept the project or not. Of course you will accept. Adjusted present value, right, is 10.4 million. Now some notes is there which you need to go through. Okay, in calculating the present value of the tax shield and the subsidy benefits, annuity factor used is based on 4% to reflect the normal borrowing or default risk of the company, right? Alternatively 2 or 2.5%, right? 2% is the risk free and 2.5 is the 10-year government. Could be used depending on the assumptions made. So you can, it's not that you only have to use the 4% borrowing rate. You could also use, right, some of you can use 2% or 2.5%, but you have to give your assumptions then that you have used this rate, why you have used that rate. So it's not correct, it's not wrong, but you have to give your assumptions. Okay, credit will be given when they are used, okay, where they are used to estimate the annuity factor, where the assumptions is explained. So if you have explained your assumptions, you can use the annuity factor at 2% or 2.5% also. Now let's go to B. That's it all about A. Let's go to B. B is theory part, so we can finish it fast. B is about the corrections made, the approach will be used, and assumptions, right? So B, corrections made to the original net present value. Okay, I'm reading line by line because each line I have read this before, just now, before I'm presenting this video to you. So I have felt that each line is very important for you to understand. So I'm going to go through each line. Okay, the approach taken to exclude, okay, depreciation from the net present value. The approach taken to exclude depreciation from the net present value computation is correct. Why is that? You just cannot say it is correct, it is wrong, and full stop. You have to explain why it is correct, why it is wrong. But yes, depreciation you don't have to explain, but tax allowable depreciation you have to explain, because depreciation already they have explained in the questions, in the case study, that depreciation is a non-cash expense, right? Non-cash item. So it is not needed in the net present value. Net present value only deals with cash items. But tax allowable depreciation, whenever you talk about depreciation, also you have to talk about tax allowable depreciation. But tax allowable depreciation needs to be taken away from the profit estimates before tax is calculated. reducing the profit on which tax is payable, right? Why is this? Can you understand? Can you understand behind the scene? Because when you write profit, what do? You deduct the depreciation, right? So because you deduct, your profits reduce, right? So here, tax allowable depreciation. Also, I have to reduce your profit, because when your profits are reduced, the tax you pay will also reduce. You need, because you are saving tax by having this tax allowable depreciation. So how are you going to show that saving in tax? You have to reduce the profit, because lower the profit, lower the tax, right? So tax allowable depreciation is to be taken. That's why you need to reduce this from the profit estimates before tax is calculated. Before tax calculated, you have to reduce this from the profit, tax allowable depreciation, reducing the profits on which tax is payable. Interest, just say this to this. Just see all this. They are in different paragraphs. Just 2 lines, 3 lines, 2 lines, 3 lines. Even your answer has to be presented like this. They are talking about each item separately in separate different paragraphs. They are not including everything in one paragraph. You also have to do this. Each thing. Now they are talking about interest here. Here they talked about depreciation in the first one. Second, they are talking about interest only. Third, they are talking about something else. We'll read it. Okay, so these are the techniques you have to apply in your exam. Divide into different paragraphs. Okay, let's read the second one. Interest is not included in, normally not included in the net present value. Okay, instead it is normally imputed within the cost of capital or discount rate. I have explained this before. In this case, it is included in the financing side effect. You have taken the interest, financing side effect, right? Because when you are financing, it's a debt. On debt, you have to pay interest. So you're taking interest there. Third, let's go. Third is they are talking about the inflation. So cash flows are inflated and the nominal rate based on Linto companies all equity finance rate is being used. Whenever your cash flows are inflated, you have to use nominal rate to discount. Remember that. But not the nominal rate of the borrowing companies. The nominal rate of Linto companies. We'll see that later when they give they have also given the assumptions for that also, why they haven't used their company and they have used the Linto companies. Okay, where different cash flows are subject to different rates of inflation. Applying a real rate to non-inflated accounts will not give an accurate answer. This is very important. Whenever inflation is different, for example, in this case, sale has 8% inflation, project cost has 4% inflation. In this cost, how can you use real rate? Real rate means you are not inflating, and real rate is one rate only. So it's not possible. It will not give an accurate picture. And the fourth one is they're talking about the working capital requirement. Now, have you seen how they have divided this answer? The same answer you also can write, but in a different way. But this one is very effective. First talks about depreciation, second talks about interest, third talks about inflation, fourth talks about working capital requirement in different paragraphs. So the impact of working capital requirement is included in the estimate as, although all the working capital is recovered at the end of the project and the flows of the working capital are subject to different discount rates. This many of you will be confused why it's different discount rates. Working capital is based on what? You're taking 20% of the anticipated sales, right? Sales are inflated at what percent? 8%. So even if they're discounted, they'll be discounted, right? They're inflated at 8%. So even when the sales are calculated that way, even your working capital will be discounted different rates, right? They are subject to different discount rates. Okay, when their present values are calculated, when you're calculating their present values of the working capital. because the amount of the sale each year and the inflation is different. Each year you're having different sales amount, right? Not the same sale that you're inflating each year. Approach taken, right? You have to use these headings. These headings you need to use. First one is corrections made to original net present, then the approach taken, then the assumptions made. The way the requirement asked you, you have to present your answer. First they asked about the correction, then they asked about the approach, then they asked about the assumptions. You have to divide this into different paragraphs with different subheadings. Make sure your answer is also like this. It follows this method, this format. So approach taken. What is approach taken? Let's read. The value of the project is initially assessed considering only the business risk involved in undertaking the project. The discount rate is used based on Linto company's asset beta, which measures only the business risk, right? Asset beta only measures the business risk of that company. Since Linto company is in the same line of business as the project, right, it is deemed appropriate to use this discount rate. How? Just see how they're justifying that why they have used Linto company, because it is in the same line of business as the project. So therefore, it is deemed appropriate to use this discount rate instead of 11%, which Burang company uses normally. Okay, the impact of debt financing and the subsidiary benefit are then considered. So they are saying the order. First you have used this 11%, then you are showing the impact of debt financing and subsidiary benefit. In this way, Burang company can assess the value created from its investment activities and the additional value created from the manner in which the project is financed. In other words, they are talking about adjusted present value only. And finally, let's go to the assumptions made. Right? It is assumed, okay? It is assumed that always give your assumptions. It's must. Right? This is the way you're going to score marks. So it is assumed that all figures used are accurate. So this is assumption 1. Okay, and any estimates made are reasonable. Okay, you can memorize some of this and use in your answer. Burang company may want to consider undertaking a sensitivity analysis to assess this. This is an important thing which you need to mention. It's good if you mention it. Always try to put this sensitivity analysis. Like you can say that they may want to consider sensitivity analysis, or it is good if they consider sensitivity analysis to assess this. Put this line in your answer. Okay, let's go to the second para. Here also the way they have divided, just check. First line they just talked about the figures that is correct and estimates. Second they are talking about the working capital requirement, right? So it is assumed that the initial working capital required will form part of the funds borrowed. Funds borrowed first was 38 million. With that we also have the working capital needed. So it is assumed that this also will be required. But the subsequent working capital requirements will be available from the funds generated by the project. The validity of this assumption needs to be assessed. Right? Why? Since the working capital requirement at the start of years 2 and 3 are substantial. Just go to 2 and 3 working capital. Just check. It is 8.54 and 12.36 is very huge. While we are only having here is 4.97 in year 1. It's very big, right? Substantial. So therefore it needs to be, so the validity needs to be tested. And finally the third para. It is assumed that Linto company's asset beta and all equity finance discount rate represents the business risk of the project. The validity of this assumption also needs to be assessed. Always write this kind of sentences. Whenever assumptions, you're talking under assumptions, right? Put these lines. The validity needs to be checked, try out sensitivity analysis. Okay, it makes your answer more credible, right? For example, intercompany's entire business may not be similar to the project, right? And it may undertake other lines of business. In this case, the asset beta would need to be adjusted so that just the project's business risk is considered. It may take other line of business. All this you need to bring out in your assumptions, right? So this is how you need to write about. That's it. The next is we are left with question 3. That I'll be uploading in the next video. In the next video, we'll be going through the question 3 of specimen. So thanks for watching. I hope you like this video. If you have liked this video, please put that thumbs up. Share this video, friends, and practice. See you till my next video.